Good afternoon, everyone, and thanks for joining us for today's presentation. Stress-free stress testing, what regulators are expecting and how Ardmore can help. We appreciate your taking the time to join us this afternoon. We estimate that this presentation will be about 45 minutes long, and we will be leaving the balance of the hour for questions. If at any point during the presentation you have a question, please feel free to place it in the questions box on the right-hand side of the screen, and we will get to those after we're finished with the informational session. And now I'm going to turn it over to Ardmore's Executive Vice President and Senior Director of Credit Technology, Peter Cherpak. Peter?
Thanks, Matt. And good afternoon, everyone. Thanks for joining us on this discussion of a topic that's pretty much front of mind of the regulators and community bankers. So we'll talk a little bit about why and what we're going to try to accomplish today. Okay, so our agenda is we'll do brief introductions, then we'll talk about really the regulatory environment and the context for how we approach proactive risk management techniques like stress testing. And then Todd Sardich will talk a little bit about the approaches we use, the methodologies and the process. I'll talk a little bit about the data management challenges that go along with stress testing for community banks. And then we'll talk a little bit about what Ardmore offers to help the industry. If we'll take questions, and if you guys are reticent to ask questions, we'll just do a demo of a stress testing program so you can see how that looks. So that's the plan. Just to introduce Ardmore. We've been supporting community banks for over 25 years. If you don't know us, we're a full-service credit risk management consulting firm. We have 3 lines of business. We do outsourced and co-sourced loan review, both on-site and remote. We do credit risk consulting, which includes helping banks who are under agreements, banks who want to look at their policy and mergers and acquisition. And we have the credit technology group, which I manage, which helps automate credit processes for community banks. We try to help banks get away from spreadsheets and manual processes into affordable and useful tool sets like stress testing and ALLL and CECL. That's who we are, and we've been involved with stress testing really since 2009 when we came out with a community bank product, and we were the first to market with that. It was built by us with the help of 9 community banks who were looking for a solution to the stress testing problem. Again, I'm Peter. I'm the manager of the group. I do a lot of speaking at conferences as well as writing white papers and articles, mostly about credit data management concerns as well as now CECL and what the CECL challenge and how it can be dealt with. Todd Sardich. Todd, you can say hello.
Good afternoon, everybody.
There's Todd. He's really our specialist on the ALLL, and he just performs a lot of our outsourced stress testing reporting, and he's going to talk about the methodologies that he uses. Okay, so the context of this discussion is really about proactive credit risk management practices, best practices. I think that almost the entire industry understands now that backward-looking risk practices don't always work. We have really been dealing with looking backwards at what has happened in the past and projecting that to the future. Now, the regulators and the auditors really want you to be looking forward. And that's why there are new regulations and tool sets and best practices that are more future-looking. And they're all supported by having empirical, auditable data. This becomes more important under CECL, but under stress testing still, the underlying foundation of everything you're doing is really your data. And the 4 areas that are primary interest now to regulators are concentration management, which we'll talk about, community bank stress testing, and I call it community bank stress testing because we're not talking about Dodd-Frank stress testing here, or balance sheet. We're talking about credit stress testing or sensitivity testing, which is what the regulators want community banks to do. And how that folds into capital planning, which we'll talk about when Todd gets on, and CECL ALLL models that are future-looking, which we won't go into any detail on in this presentation. And there's a whole issue of that data set being something that's repeatable, auditable, controlled, and consistent. So if you are doing these different things, there has to be consistency within the projections within the data. And if you were to use one set of data for stress testing, another set of data for your ALLL, and yet another for your concentration reporting, that's going to be in conflict quite likely, and the regulators are not going to look upon that favorably. There has to be some governance so that all the information makes sense and it's controlled and there's ownership of it. Now, before we get started, I thought we would do a poll, and I'm going to ask Matt here to do a quick poll for the audience. And this will be a poll really asking about stress testing. And you should see it on your screen. And if you would just give it your best answer, what we're really asking you about is, why do you stress test? And it's something that we think is very useful when we talk to our audience about why you do it. Now, if you don't do stress testing at all on a regular basis, that is portfolio stress testing, you would pick the 0. The first item, if you do it because the regulators told you to do so, then you would pick the second choice. If you're doing it because you weren't told to do so, but you feel that it's something you should be doing as a best practice, then you would pick the third answer. And if it's sort of all of the last 3, you would pick the fourth answer. So appreciate if you take a moment to click on the radio button and indicate your choices would be helpful. We'll hold it open for another minute or so. Don't want to take a whole lot of your time. But these are all reasons that people stress test, and except for the first one. And it's important that we try to get across to you in this next few minutes that there's more value to stress testing than only meeting regulatory requirements. And I think that's a takeaway for all of these regulatory imperatives, such as concentration management, capital planning, and even CECL. There are benefits to the institution beyond just meeting the requirement. And hopefully we can share some of it with you. All right, we're about to close the poll, and I guess we can show you the results. Okay. So we can see that the majority of the people on the phone feel that they're adhering to regulations and using it to help inform management. And a good third of you are looking to get ahead of regulatory requirements. And it's like about 10% don't stress test at all right now. So appreciate it. Thank you for your input. All right. So we'll move on. So one of the things about this stuff is that banks tend to get very involved immediately in the modeling issue. And that's understandable. I mean, I was just talking to a banker who said, I hired my first quant and was pretty excited about it. We think quants are important. We think modeling is important, thinking about your infrastructure. But the base of all of these practices to be successful has to be your data, your portfolio data. And it's also your longest lead time. This is one of the reasons why, for example, the CECL rule was given out multi-years before it was implemented, in that because it's so dependent on data, you really need to pull your data together first before you even make decisions about how you're going to apply the rule. Stress testing is similar in that stress testing is based on portfolio risk characteristic data. And that's really the thing you got to get right to begin with, and then worry later on about the models and the quants and things like that. So it's a really long lead time, first thing that you need to worry about. So it's all really about portfolio risk, credit risk management, and the idea of identifying, monitoring, measuring, controlling risk. It is not intended to be a one-time event. It is intended to be an ongoing process. It's not just saying that you're doing it, it's actually doing it. So you maybe saw the term stress testing program that I put in the question. That's because we really think stress testing is an ongoing process. We have had clients over the years, we've had over 60 banks using our stress testing tool sets or our reporting. And sometimes they stop, and we always ask them, why are you not using it anymore? And they usually say, because the regulators haven't asked me about it in the last few quarters, so I'm stopping. And that's not the kind of behavior really that the regulators and auditors want to see. They want to see a repeating process that grows with you, that changes with your institution, and it's just part of the fabric of what you do. So stress testing is a great way to show evidence that you're proactively managing your portfolio and can help you if you're in an institution that's growing or you're in a mode of changing into new product sets. The regulators like to see that you have enhanced risk controls like stress testing. There are still concerns about CRE. And here we are in 2017, almost 2018, 12 years after the guidance came out, or 11 years after the guidance came out. This is coming from a presentation made by the OCC in May. They're concerned about increasing concentration levels in the CRE, and they expect them to continue to increase. And you can see that the total amount of multifamily is up almost 2/3, and construction development as well, and non-owner occupied is up 50%. So these are some pretty big numbers, which is one of the reasons why the regulators have started to look for banks to evidence increased risk control of their portfolios. And that typically will include concentration management and stress testing. You can see that as of the fourth quarter, the end of last year, about a year ago, they had 72 banks exceeding one of these criteria, which are the 2006 guidance on CRE management criteria. And 38 banks are all, have a number of them you can see. Some of them, I think they said at least this has increased significantly since these numbers were released. So certainly it's happening, and they're looking, the regulators are looking for you to evidence that you are prepared to manage this kind of risk. An example from their presentation of the growth. And you can see in this slide, what they're showing is that at the end of, really 2007, they started tracking the CRE, specifically non-owner occupied. And this is where the sort of cliff happens here, where you can see that it drops down and then it starts back up. And we're already up to almost the same place for non-owner occupied as the entire CRE portfolio was back in 2007. So they're seeing the warning signs, and I'm sure you are as well. The FDIC has a quarterly periodical called Supervisory Insights, which you may be familiar with, and you can see here that they're saying that feedback from their examinations of CRE lenders have observed some issues. One of them is, you can see the absence or unsupported or excessive limits on concentrations. So if you have a significant concentration, there should be some sort of limits, and that would typically be by segment, which we'll talk about a little bit more. That segment within the non-owner occupied portfolio. Inadequate reporting of concentrations to the board, and the lack of any documenting of that discussion regarding concentration. Concentrations are considered bank killers by the regulators. So if you're not talking about it and you're not evidencing it by putting it in your board minutes and showing reports with empirical data to support it, you may be criticized. And finally, use of inadequate or poorly supported risk factors within stress testing or sensitivity analysis. So poorly supported risk factors means data, or inadequate. And they put in their, the end of their statement, it's time to focus on strengthening risk management practices now as portfolio concentrations are building. So the idea is not to wait until you are told to do it, but to do it so that it's there in place when your concentrations grow to a level of concern. So just a quick refresher on concentrations, because that's really where stress testing starts. A concentration, according to the Comptroller's Handbook, is any category of loans with like risk characteristics that make up 25% or more of your capital. What is a category of loans with like characteristics? That could be, for example, CRE, or it could be a subsegment of that, like, for example, multifamily or retail. It could also be something in outside of CRE. Concentrations exist all throughout the portfolio. So it's really a matter of identifying, measuring, and monitoring concentrations. And it all comes back to MIS, or Management of Information Services, which is capturing enough data so that you can stratify and stress test. You really can't do it without the data. So it goes back to the origination of the credit. What data are you capturing that are risk characteristic items like borrower financials, type of properties, owner-occupied status, cash flow, cap rates, all these sorts of things are the things that they're concerned about. And you need it for stress testing. You can use it for CECL as well. So some examples of concentrations to manage here on the screen. This comes right out of their Comptroller's Handbook. So you can see on the commercial side, we're looking at property types, geography. There are all different ways that you can do it. And the regulators like to see you do it as many different ways as possible. They like the idea of being able to do, for example, a stress on appraisal value, but also then a stress on cash flow, and see that they're in order. You might want to be doing a couple of quarters of property value segmentation, property type segmentation, and then flip over and look at geographical concentrations. So there's a lot of ways you can do it. The nice thing about concentration management is it takes unknown risk, and by going through and identifying your concentrations and managing it, you can identify where the risks are. So it doesn't reduce risk, it simply makes the risk known. So stress testing in general, it is confusing to people. There are many different types of stress testing. It means different things to different people. Those of you who are my age may be thinking about strapping sensors on your body and running on a treadmill, but the regulators are really thinking about the bright lines that are put in place by Dodd-Frank and other regulations. So below 10 billion, which most of the people on the phone are, really the expectation is that you're doing stress testing yourselves. It can be a simple fashion. In 2012, the OCC came out with their recommended community bank stress testing methodologies. The FDIC published their own version of that in the summer of 2012. It is not a regulation, so you don't have to do it. But at this point, there's an expectation that you are doing it, particularly if you have concentrations in your real estate portfolio. Above 10 billion, you have DFAST, Dodd-Frank stress testing, which is more of a balance sheet stress test, going across the balance sheet and looking at the impact of stress on the capital levels of the bank. The community bank stress testing does feed into capital planning, which Tyler's going to talk about in a minute, but the Dodd-Frank, it's very specifically linked. If you're above 50 billion and you're on this call, that's great, but you have to worry about CCAR as well, which is an entire capital stress testing regimen. Oh, and I should point out that just because you're doing one of these and then you switch to another, doesn't mean you stop doing the other. So if you become a $10 billion bank, it doesn't mean you abandon concentration stress testing. It simply means in addition to that, you did Dodd-Frank macroeconomic stress testing. Dodd-Frank stress testing the impact on Tier 1 capital is a little bit different than looking at your concentrations and doing sensitivity shocks against it. So you would continue to do both. There is hope on DFAST. If you're a bank that's near or thinking of the $10 billion line, you can see this quote from October from a speech by the OCC acting controller at the time, Keith Norica, basically saying that they want to raise that $10 billion line to 50 for any kind of Dodd-Frank stress testing. This would be a boon to community banks that are sitting near the $10 billion mark. But you know how it is with government and politics. They could say they want to do that, but until it's done, you really can't tell a regulator that you're waiting to see if it'll get passed or not. So what I want to do now is turn this over to Todd, who's going to talk a little bit about really the regulatory emphasis on stress testing, and then a little bit on methodologies. So Todd?
Thank you, Peter. Good afternoon again, everybody. Peter mentioned a lot about forward-looking metrics when we're looking at stress testing, and this is going to primarily focus on more of the concentration level community bank type stress testing, more in the methodologies that I'm going to discuss here. A lot of the metrics that we're looking at when we're talking about investor, non-owner-occupied portfolio properties are things looking at trends in vacancies, trends in occupancies, market rents, cap rates, things like that. Where are they at today and where are they going to be? Now, a sound stress testing framework is going to include multiple methodologies for each one of the metrics that you're going to be measuring. So, while you might be looking at trends in value and what is happening in that market, not only you're going to be looking at adding stresses to changes in appraisal values or collateral values, you're also going to be looking at what are cap rates doing in that market as well to kind of align those two metrics alike. Banks are going to need to construct their own appropriateness of their methodologies based on the markets they operate in. There's not going to be a one-size-fits-all type adjustments that you're going to want to make in this process. So when you're developing these forward-looking metrics that you're going to be looking at, the market considerations in a particular market that you're operating in are going to drive a lot of that. That kind of leads into the next bullet point, market conditions. One of the first and most important steps in any stress testing that we do and that we recommend is to normalize your data. That Peter spoke of, making sure that the data is actually captured and tracked. The first step in the process is going to be bringing that data to where it is today. And what I mean by that is a lot of times data is captured at the onset of a loan origination, and it's could be 12 months, 24 months old by the time that you're actually going to perform a stress testing on that loan in particular. So one of the first steps you want to take is to say, from based on the weighted average age of the information that I have in my concentration, what has that segment done since that time? So for example, if you have a cap rate, the weighted average cap rate of a segment for a retail property was 5.5% 24 months ago, and that same cap rate today is 5.1%. You want to make sure you apply that adjustment as a baseline as you're going ahead. So when you're looking at different market conditions, normalizing those inputs, if you will, to your stress testing model is important to create a baseline. Now from there, you want to, in developing your stress testing scenarios, you want to look at developing kind of the worst case scenario from there, which would be a severe scenario, and we generally like to recommend mimicking decreases and declines that we saw during the Great Recession. So if you establish a baseline and you have your severe data point, then you can fit your initial and your moderate stresses in between those thresholds and those bands that would be appropriate for your bank. Results. Results should be meaningful and actionable and communicated to management. What is this data really telling you? If you're seeing adverse outcomes in mild stress testing scenarios, you might want to look at potential changes that you make in underwriting or policy. But on the contrary, it might tell you, very good outcomes. You can look at something where a segment in particular might perform very favorably under a severe stress, where you might be, making a very large decrease to collateral values and cash flows, and it might still perform very well. So being able to assess that data and report it to management is important and ongoing in routine credit risk management. Peter spoke a little bit earlier about tying this to capital. One of those outcomes of stress testing that that we have in our model and that we look at in particular is what is a potential collateral shortfall that might come out of a particular segment under a scenario, and what is that telling us? Well, the collateral shortfall for a particular pool isn't necessarily a defined loss, but it's a potential loss given the effects of the scenario should they come to fruition. So being able to correlate that loss to a particular default or a historical default rate would give you some impact on insight into should this come to fruition, these would be the impacts on our capital. Another way to tie your stress testing results into capital planning might be on a pro forma basis. If you're a bank that is considering an acquisition or has is in the process of acquiring a bank, we have a client that I recently did an analysis for where they had acquired a bank, and we had obtained the same information prior to closing, so they would be stress testing information, so they would be able to use that information in a pro forma capital picture at closing. So there's many ways that you can tie this information and relate it to capital. And questions 1, 2, and 3 that are shown there below, asking yourself the question, is the capital sufficient given our risk profile? What portions, based on the stress test, are most vulnerable to market stress, and should any of our strategies be then adjusted thereafter?
Yeah, and I think just to underline what Todd said, the takeaway here is minimally is your stress testing shouldn't be just a mathematical exercise that says what happens if we have a 10, 20, and 30% drop in appraisal values. It should be tied to some sort of market metrics, because that's really what the regulators want to see, is that you understand that how the market performs, how your portfolio performs against market change. So if you do stress testing exercise, and I've seen these before and I've seen them criticized, where they're simply small, medium, and large, that's not really going to get you the same sort of appreciation as one based on actual market fundamentals.
This is covering the 5 stress testing fundamentals that were provided from the different regulatory agencies as kind of a baseline when you're developing your framework. Stress testing, this was already discussed in a prior slide, but the stress testing framework that you're going to develop within your institution is going to be created based upon the specific composition of your portfolio. So some banks that are heavier in construction and development lending are going to have methodologies that are particularly pertinent to that. Others in multifamily, et cetera. So the point in this is developing your process in using metrics that are going to be pertinent to the type of lending that you're doing. So we talked about retail properties earlier. For example, market rents, applying stresses to cash flows based on changes in market rents or vacancies are pertinent to that, but they wouldn't be pertinent to a 40-house subdivision where you would test things like absorption rates, loan to cost, things like that. Number 2, an effective stress testing framework should employ multiple stress testing approaches. I used this example earlier. When you're looking at things to apply to changes and fluctuations in LTVs, you wouldn't want to look at just appraisal values. And again, this is driven in some degree on the availability of the data, but if you have the availability to capture things like appraisals as well as NOIs and cap rates to perform a direct capitalization approach to it, this gives you a little bit more insight into aligning them more directionally against each other and giving you the ability to look at changes on both the collateral as well as fluctuations in market rents and cap rates and cash flows to establish that value. Forward-looking and flexible, we talked about that a little bit earlier as well. You don't want to just make a model that is going to be something that we put inputs into and it gives us a result and we analyze it. Try to incorporate that into an ongoing discussion where it might be an annual type thing where you're looking at it and saying, are there any changes that we want to make to our model, and having the flexibility in the availability of the data to do that. And number 4, stress testing should be clear and well supported. But speaking from the well supported standpoint, one of the traps that you don't want to fall into is just making arbitrary adjustments when you're doing and creating stress testing scenarios and saying, for example, my initial stress test, I'm going to decrease 5%, and for my severe, I'm going to do 20%. You really want, regulators are really expecting banks to correlate the adjustments to current market environmental factors as well as expected ones. So having that documentation and aligning your methodologies to market conditions is very important when you're doing that. And finally, a company's stress testing framework should have strong governance and internal controls. And that stems from having a process in place to capture the data at the origination process and then controlling it thereafter. We have several clients that in their ongoing annual review process where they're updating financial information and spreads on an annual basis. They're capturing that data on an ongoing basis from there. You know, the degree that you can continue to do that is going to greatly improve and continue to improve your stress testing process. So you're not using data that was, you know, 2, 3, 4 years old from origination. You can normalize that data, but having current data, if it's available, to put into your stress testing model is important. And, you know, testing, you know, ongoing governance over the model and making sure that the calculations that you're using in the model and it's producing the outcomes is you know, reviewed and governed.
Yeah, Todd, I think you're right, and I think the one thing to make clear is that these are regulatory guidance points, and they apply to all stress testing. So whether you're doing a Dodd-Frank stress test or you're doing a community bank concentration shock, these 5 items are pretty fundamental. So
go ahead, Peter.
No, I was going to say, you know, we know that concentration, we talked about how concentration management creates known risk. I guess the idea of applying a market shock is going to tell you whether or not you have specific potential risk in particular concentrations, because, Todd, I mean, you can point out, you know, we've seen results, and you mentioned this, where shocking a particular segment has turned out to be fine, and others not so fine.
Yes, yeah, and I mentioned that where you're looking at a certain segment under a very mild stress, where, you know, 20% of the loans would breach an LTV threshold that you would put in place, or you would say, show me all of my loans under stress testing that would breach an 80% or an 85% LTV under the stress tested scenario. You know, that's one side of the coin. The other side of the coin is where you make, you know, changes that were seen, you know, in 2010 and 11 to collateral values with a weighted average LTV of the portfolio or the concentration of, you know, 85%. So, you know, going through this process will give you that, you know, segment by segment analysis. And this is just a graphic, you know, that we wanted to take a look at here when you're looking at, you know, the changes that stress testing would give on an individual basis on a bottom-up approach. You know, this model shows changes to collateral values negatively, and it also increases debt service. And the combination of those shows the net effect of, you know, the increases of LTV and the compression of debt service coverage ratio. Again, actionable results at the borrower level, and then aggregated up to, you know, per segment or per concentration level to analyze. You'll see in there the collateral shortfall. I spoke to that a little bit earlier. You know, the first one there shows a potential collateral shortfall of 313,000. What that's showing you is, again, under this scenario, should these declines in property appraisal values come to fruition, and should they decline to $12 million, as it shows there, the potential shortfall of the collateral is 313,000. It's not implying a defined loss. It's not implying, you know, a definite need for additional provision or any effect in the ALLL. It's just going to give you insight to, you know, should this come to fruition, this is what could happen. Now, a lot of banks like to apply a default factor to that based on their historical experience. Say this loan is a multifamily project, so this is a multifamily segment, and our historical loss rate or default factors on this was X. You would then apply that to your potential collateral shortfall to see what the impact on capital would be should that come to fruition. This next slide is an example of top-down stress by segment. These are a lot of the important metrics that we like to look at. First, to identify concentrations as a percent of capital. You'll see that there's a percentage there, both of the segment balances as well as a percentage of Tier 1. That's normally the first step in the process of beginning your stress testing and looking at where are your largest concentrations. From there, we're able to have insight into looking at the base data as well as how old is the data, because that's going to play a very important role again in normalizing that information and bringing that to current. One thing that we're seeing in normalizations nowadays, particularly in the last 12 months, is current values for the majority of properties, and mostly all of them, have exceeded their previous peak values prior to the Great Recession. So what you end up having is, in most cases, is a positive adjustment in the normalization process. And you say to yourself, well, I'm doing stress testing, I'm going to add, I'm going to actually make a positive adjustment. That doesn't make any sense. But what we're doing in those situations is, once you're at the normalization point and you're bringing it to the current levels, you're just going to have to make a larger increase on your severe and your moderate scenarios to get you, back to that level. Is really what that's showing. This is an example of an aggregate top-down adjustment on property values and debt service. So here we're decreasing property values roughly 29%, and with a corresponding increase of debt service of 25% of the multifamily segment, with about $121 million in loans. You'll see on the side, I spoke to this, I think, on the last slide regarding the breach levels. So it's an important metric that you're going to want to pay attention to. Setting up pre-established tolerance for limits for loan to value and debt service coverages. In this case, it was 80% LTV and 120 debt service coverage. At the bottom, it'll show you, in our model, for example, we're looking at, under the scenario, what percent of our portfolio is going to breach that amount. In this case, it was 100% on the LTV and roughly 74% of the debt service coverage. And again, another good metric to look at, to trend, to track over time, and report on a regular basis. So, basically, again, it's from the, a lot of banks are going, if you're not doing any type of stress testing, and I saw that there was roughly 10%, I think there was, that it's not doing anything. This is certainly not something, the framework that you're going to build overnight. It's something that you're going to gradually begin to, gather data, and the more robust you make your stress testing framework as you go on, it's going to grow over time. It's going to take, time to get there and to gather that data, because that's the foundational piece of the puzzle.
Yeah, I could just add that this report in particular, our program uses this report. We took this out of the FDIC's Supervisory Insights. This is how they like to see it. They're the ones who set up the concept of the yellow zone and the red zone. And so this is, we think, a pretty good way to show someone who may not really understand the modeling piece, but they can certainly understand how the portfolio moves, into risky areas based on the stress, the before and after.
Yeah, certainly. It's a one-page, it's a one-page look at it before and after. It paints a pretty interesting picture on some of the segments. So with that, I'm going to turn that over to Peter. Peter, go ahead.
Okay, thanks, Todd. So we don't, our community banking stress testing approach is maybe a little different than some of the other vendors you might be working with, in that we really like to train you on how that works, because we think, number one, we're a risk consulting firm, so we tend to train people as opposed to just give them results. And in this case, we want you to understand the methodology, but we also want you to understand why we choose the stress that we do, why it's meaningful. And that way, if you get questioned by the regulators, if you get questioned by the board, you can explain why it was done the way it was done, and it actually is more meaningful to the bank. We've never had a regulator question our stress testing reports, except for one exception, when the bank simply handed the printed report to the regulator and didn't explain any of it, why it was done. And the regulator said, well, this is just a report. Tell us about your program. So we try to support that holistic view. One of the things that we do is we try to bring you up to date on the latest regulatory expectations. We take a look at your portfolio for concentrations. We walked you through that pre-stress report that we use. So we'll be looking at that and telling you where we think the concentrations are. Sometimes one of the things we find out is the data is not sufficient to support stress testing. We have a number of clients who don't really segment their portfolio completely. They may have something called special use, or they just have other CRE. We really would go back to banks and say, we think that you need to get a little more specific on some of the larger credits so that we can slot them into segments for stress testing. We will also take a look at the data you have in combination with the type of credits and the portfolio mix and recommend particular models. So Todd mentioned there'll be different models for construction and development loans than there are for looking at, let's say, retail loans or office buildings. So we recommend what we think is the best way to do it and get the bank's approval before we proceed. We do believe in the 80-20 rule on this. I think a lot of banks get tied up and think, well, this is a very specific scientific process. It's not. It's a directional one. So if you get 70 to 80% of your loans coded properly, then you can do this. And usually we have you start with the largest credits and work to the smallest. Todd mentioned the normalization. We want to understand how old the data is we're working with so that we can normalize to current conditions. We would create our own scenarios of stress, and that's really the secret sauce as to how much you stress by. We mentioned that we tie this to market performance and as well as portfolio history. We have seen just about every anomaly there can be, and we work with you. So if you have things that come churning through the model and it comes out with an LTV of 4,682, we would probably tell you there's probably something wrong in the data. It's something that we take a look at, and we will help you work through those cross collateralizations or things like that, multiple liens can cause problems. And if you're using our stress testing service, which is our outsourced service, we write a narrative. If you're using the software and doing your own, we will give you some guidelines on what we think an outline of a good narrative would be. And there are sets of reports and charts like the ones we just showed you that you can use to support your efforts.
Peter, just one more thing briefly on that. The narrative, speaking a little bit more on the narrative, I mean, that is one of the components to always take into consideration of being just as valuable in this process as the actual data, because showing the regulators as well as internal board and bank management that you thoroughly vetted what's going on in the economy, what's going on in your marketplace, what's going on in the segments that you're analyzing, and tying that information is just as important as the output of the results. So I just wanted to mention that if you're doing this internally, that maintaining or developing narratives to include in your stress testing framework is very important consideration. Thank you.
Yeah, it's true. And and for CECL, I can tell you that all of CECL is about the narrative, because the numbers are so subjective and open that it's really how you explain it and justify it that matters. Stress testing is similar, but obviously not as severe as requirements of CECL. So, data is the issue. I'm not going to spend a lot of time on this other than to say smaller institutions, typically the problem is you don't have enough of it. It's not being retained. We do credit data assessments for banks. We've done over a dozen of them in the last year or so, where we come in and take a look at how much data you're capturing at origination, where it's going, what the workflow is there any quality control over it? We've seen examples where lenders can just slap a property tape on a multifamily, and when you look at the property data, it turns out it's actually a horse farm. So yeah, it's a multifamily of horses. It's not really what you want to see. Unstructured data, meaning a lot of things on spreadsheets and the like. So our product allows you to import spreadsheets because some of this data isn't in the core at all. Larger institutions generally have problems with data silos and ownership, where finance has its set of data and credit has its set of data, and they don't match. So they have big data to worry about. So I have my little cartoon about it's kind of like the old how a bill gets through Congress, but how data gets through into reports. Typically people are putting that data into loan origination systems. It's moving through a credit memo approval process into a doc prep system and into the core. Who's making decisions on these codes and who's checking them is not always clear. or it's not even always done. They have core operational reports, but often there's a reporting system that is used to generate reports that go to either on-demand ad hoc or interpreted into spreadsheets. Borrower financial analyses continue, but the data doesn't ever get updated. And then, data gets sent to upstream into stress testing and ALLL and the like. So this kind of process really is not good governance or control and really needs to be streamlined. Doing it for stress testing is great, but we think there's more to it than that. And I'll kind of leave you with these ideas, and we'll take time for some questions. The typical current state of a bank, particularly a community bank, is they don't have a lot of governance around information other than what's needed to get the loan booked, accruing properly, and billing the client. There tends to be all these scrubbing processes that follow on after the fact. We highly recommend that you, as an institution, do an assessment of what your data gaps and your processes and controls. You can use Ardmore to do it. You can use other vendors. You can do it yourself. But the idea is you need to document the process so that it becomes a repeatable, auditable process with controls, and you identify your data gaps and show the regulators that you're out there filling those gaps, because you're going to need it in the long term. In the long term, you want to create one version of the truth, which is a secure historical data mart that becomes your data set, use it as many ways as you can. Once you've gone through the effort of building this data up, whether you're building it up for stress testing, you're building it up for CECL, you're building it up to do concentration reporting, it should be all the same data set with the same controls. That's really what you're shooting for. So what we can offer you, and then we'll take questions, we do a credit data gap assessment, which is a 2-day process. We can do it on site at your institution. We've had very good results with the process where we've come out and made short-term recommendations and long-term recommendations on how to improve data quality, as well as being ready for stress testing and CECL. We support the Argus CPM suite, which is a credit data mart, a hosted secure data mart that you can use to build up your information and feed it with core data, feed it with spreadsheets, feed it with loan origination information, and use it as many ways as you can. This includes a stress testing tool that allows you to do these. You can see the models here on your screen. All of these can be done pretty simply with the tool set. We also offer a service that does stress testing as a outsourced service. So we're pretty flexible on stress testing. In this case, if you want to take control yourself and utilize stress testing as a tool set you can use right away while you build up data, and you can use it for credit reporting and concentration reporting go forward, you could use our product set from Argus, and then eventually you'll be ready for CECL as well. If you're just interested in solving the stress testing problem, we have an outsourced service that's used by dozens of banks where we do the report for you. You basically give us your data, and we do the rest. We obviously consult with you throughout the process to make sure that we're following the kinds of issues that are unique to your institution. We can do this on quarterly, semi-annually, or annually. And to finish the advertising, I can tell you that for the institutions that are registered on this call, we're offering a special discount if you sign up in 2017. It doesn't mean you have to actually start stress testing in 2017, but if you do sign up, there'll be a significant discount, and you can just drop us an email and we'll follow up with you. You can tell us what sort of services you're interested in, if you are interested in any of them, and we can offer you a swell deal for Christmas. So I want to see if there are any questions, and we just have about 10 minutes left. So I think we've got a couple of them. If you put them in you can type them into the question area, and let's see what we have. Maybe, Matt, you can read them so Todd can hear them, and we can decide how we want to answer them. Sure.
All right, the first question, is it a best practice to include the 100% for construction within the 300% for CRE, or as a separate calculation?
So, Todd, do you have any thoughts on that one? So I know you've been working with portfolios.
All construction construction, I like to recommend to keep it its own, its own segment. It's going to carry different risk characteristics. Construction is a very broad segment as well. So that's commercial construction, that's residential construction, that's development financing and development lending. So generally, when we do clients construction portfolios, we kind of do them as a standalone report, and the economics around that are going to be different, as well as the scenarios that are employed to do the actual test are going to be different. So let's keep those separate.
And I should add that it will be counted as part of the 100%. Part of the 300% in the regulatory threshold calculation anyway, because that's how they do it.
Okay, the next question, in managing concentrations, should a community bank focus on commitments or outstandings?
So my view on that would be to use outstandings simply because of the fact that outstanding most likely reflects the current amount of risk and exposure. And remember, this is all potential. Stress testing is not actual, it's potential. So it's telling you here's what could happen. And we're usually reflecting the portfolio at a point in time. I don't know, Todd, if you have any other comments on that.
Well, I would agree with that. Generally, your investor CRE, non-owner occupied projects are going to be, by and large, outstanding and commitment are going to be the same. Construction and things like C&I, stress testing, when you're looking at things like that, you're going to focus more on the exposure because those are going to be analyzed at different points of their life cycle. So, again, it would depend, I think, more. If you're looking at strictly the CRE stress testing, it would be on balances, and you would take commitments more into account on construction, development lending, and C&I stress testing.
Thanks. So just so you know, we have 7 minutes left. I'm just going to show you an example of a stress test real quick since we don't have any other questions. If you do have other questions, you can always drop us a note. But here would be an example of the way our program works. One of the first things we do is segment the portfolio. You really wouldn't want to run the same stress on the entire portfolio. That would suggest that you think all the property types and all the concentrations act the same under market stress, which is the exact opposite what the regulators want you to say. But we do a pre-stress report, in which case we're going to take a look at the impact of stress basically before it happens, to try to understand where the stress in the portfolio is. We could also pick a property type, like, for example, say multifamily. And let's say we wanted to do a summary of that. I'm not getting any reports to come up. I hate when that happens. Hang on a second. Let me just go back. Okay. There we go. That was a good. I guess that's what happens when you leave it open for so long. That's what we learned from this. Let me just try to bring that up real quick again. Sorry about that. The product is one that contains both capital and credit stress, so you can actually do either one. The one that is for credit is the one that we're talking about, the model during this presentation, but we also have a simple capital stress as well. But I'll show you the credit stress test again. If you, let's say we're going to pick our property type again, which is, I think, multifamily. We select it. That narrows down what we're selecting. We do a stress test summary. There they all are. So these are the different models that we can apply to the stress test. So say property value, debt service. You can see here when you pick the model, it asks you for inputs as to what your thresholds are, as well as what the percentage of change you want to apply. This is a pretty severe stress. You can then run the report out to PDF, Excel, or Word, or just view it on the screen. And basically, this is going to give you, first, a top-down look at stress, where it's going to look at this entire segment and show you the impact. And this is typical, like the screenshot we showed you before, where we had 120 million We stressed, with pre-stress, we had an LTV of 74, and post-stress, we go up to 104, and you can see the impact on the thresholds. We would then go in and look at the detail, because what you're going to want to know is, all right, well, which credits are the problem? This is also where you tend to reveal any kind of calculation errors based on bad data. And we showed you this. So in this example, Dillwyn Street had an $11 million outstanding, and we had a property value of $16 million. So our original LTV was pretty good at 67 and a 1.26 debt service coverage ratio. After we applied the stress, which you can see up here, you can see that what has happened is the property value has dropped to 11.9. One of the things that the FDIC told us to do in our model was then to put a haircut on that, a discount for collection, and that we did of a 10% hit, which is pretty conservative, I think. So now you're at really a 94% LTV, and our debt service, because of the change there and the stress, adding 25% has also gone underwater, and you can see that it's highlighted. So, you know, this is the kind of thing that you would look at in detail. You know, to wrap up, I can tell you that one of the things that we often get asked is, well, what are you supposed to do with the information? What makes it actionable? Well, they're not expecting the regulators that you would stop lending in particular segments because of the impact of stress tests, but they might expect you to look at maybe tightening your LTV requirements or your debt service coverage ratio. They might have you look at the loans that in particular seem to be most stressed, and think about having a conversation with those borrowers if you see the market conditions starting to deteriorate. So it's not a heavy action you have to take, but there is some action you have to take. So with that, I think we'll wrap this up. We appreciated your time today, and if you have any questions or you're interested in any of our services, please reach out to us with the email information you have on either your invite or what we showed on the screen. So for Todd and myself, thank you for your time, and have happy holidays coming up.